Most important factors when it comes to real estate is what is going on with the mortgage markets. Again, what we were talking about 90 days ago was mortgage markets tightening up, lenders going away, programs going away, not wanting to lend money to anyone that was not in the core of the safest bet to lend money to. And that was worrisome at the time for a lot of good reasons. But it turned out that shutting that down or dramatically slowing it down was not as impactful because so many sellers got out or never went into the market. And so while we did reduce the number of potential buyers because we reduced the number of potential options that they had, there was still an abundance of buyers to sellers. And so the market got small, but it still kept its ratio of buyer to sellers. That demand ratio was still there, which we know now looking backwards and continue to look at as markets open up. The mortgage markets are loosening up again and opening up that demand. And so far, that has recovered faster, as we'll see when we get to the local data, than the supply side. And we're not putting homes on the market as quickly as buyers are coming back into the market. So here you see from Freddie Mac, not only record lows right now, but their forecast for not only the rest of this year, but into 2021 is for as low or even lower rates. So record lows, and the forecast is that they will drop even further in 2021. Again, I have to point out, buyers are out there competing in a low inventory market, driving up prices, but the interest rates are helping them keep that monthly payment low. And you can never really know when these rates will go up, how long they will stay at this rate. And that's why I continue to say we're in that period where it's a great time to sell and a great time to buy. These are the kind of numbers and facts you need to be aware of. And while we're pretty confident that these rates will remain low to drop in the foreseeable future, that same interest of buyers coupled with a lack of supply will drive prices up. So the earlier you can get in, if that's in fact what you want to do, the better, in my opinion, simply to keep that payment down, because the absolute prices will rise. So Housing Wire, another great source for market data, if you're interested, put this out early last week. Mortgage rates tumble to an all-time low. As a recession reality sets in, investors pile into bond markets. And oh, by the way, I think somewhere in your news feed, they reported that we're officially in a recession. At least a lot of locations are reporting we're officially into recession. Different sources, different economists have different factors on when they call a recession. But the reason I pointed out is because you didn't notice. Because if you're in real estate, if this is what you think about, this is what you do all day, recession is the furthest thing from your mind. It's just, we're beating all odds and kind of our own track here. So good information to know. The average rate for a 30-year conforming fixed rate mortgage fell to a record low of 3.1% last Thursday. It came after a rocky ride that saw rates jump to a 1-month high on the previous Friday, the day the government issued a report saying the jobless rate fell in May. So you don't have to completely understand how the bond market and all of these things affect interest rates, but talk to a professional, talk to someone that understands how to read those indicators, how to understand when rates will fall, when they go up. And while we overall see low rates for the foreseeable future, they can go up day to day, week to week, month to month. And these reports are a good example of that. So stay on top of it. Overall, very low. But when you're ready to buy, you obviously want the lowest possible rate. And these are really important indicators. So Fannie Mae, again, continues to see low mortgage rates and expected to go through 2021. The cheapest mortgage rates on record are heading lower, Fannie Mae said in a forecast. According to Fannie Mae, the annual average rate for 2020 will be 3.2, down from last year's 3.9, and they see it even lower for next year. And I said earlier, all great news, but we're starting to see some buts in there. Here's one, is an important one. Fannie Mae writes, while housing took a big hit this quarter, We believe the further reduction of mortgage rates, persistently low levels of supply, and strong buyer sentiment compared to seller sentiment should continue to provide support to home prices and new construction. Why do I point this out? This right here. Strong buyer sentiment compared to seller sentiment. Buyers are in love with real estate. Buyers are in love with the idea of buying real estate right now. Sellers are not convinced they should sell right now, which is creating an imbalance in the short term, driving prices up. And that can be good, but eventually we need the supply. You can't sell what doesn't exist. So that's worrisome for me in terms of trying to keep as balanced a market as possible to eliminate price wars and things like that. We want to be long-term sustainable. We like the good news. We like the protection and growth and equity, but it has to be sustainable. And part of that is this, they point out here, it's reasonable to consider whether home buyer confidence will remain comparatively strong as fiscal policy wanes. So this is talking about the reaction from the Fed, from local state governments, from our federal government, on all its entities, on immediately pouring liquidity and cash into the markets when we got the massive shakeups in mid-March. That really bolstered consumer confidence, that bolstered our markets, that while things were bad, we pumped in liquidity, we kept it going, and the worry there, at least slight worry, Fannie Mae snuck it into this positive report, is as that wanes, as that goes away, as it ebbs, will home buyer confidence remain this high? If I'm a homeowner and I'm thinking of selling, I'm starting to pay attention to this. I know the confidence is high. I know if I put my home on the market, I'm going to get people to see it. I'm going to probably get more than one person that wants it. And I'm going to create an environment where they're going to compete and bid it up and reward me with a really, really great sales price. That buyer is okay with that because of interest rates and long-term outlook. But if you've got anywhere from a 2 to 3 month outlook on potentially selling, I think you need to pay attention to this bold section. They're not promising that the consumer confidence will stay high. What happens if there's a second wave in the fall? What happens if Congress can't agree on a second or a third stimulus? And anything like that can happen and overnight change consumer sentiment, change the market outlook. So just the way we started with the economists looking at numbers in the last 30 to 60 days and saying, wow, the future looks bright. It can return that fast. 2 to 3 to 4 weeks of bad news, we'll see those numbers change. So not anything to worry about yet, but I did feel it was incumbent on me to point this kind of not yet negative, but kind of like a pay attention, potential headwind in this otherwise really positive report from Fannie Mae. Big picture on their outlook. This comes out, they release it every month. If you're in the business, if you're in the industry, you should look at it. And I won't spend too much time on it other than if you have time, go back and revisit this and look at the outlook for the rest of 2020 and what we see for 2021. Really strong positive numbers going forward. Whatever did or didn't happen in March, April, May, it's done. You need to pay attention to what's going to happen June, July, August, and going forward. And from total home sales to prices to mortgage rates, all positive news going forward for the foreseeable future. But these numbers were not this rosy just 4, 5, 6 weeks ago. So I want to give you a little bit of caution about these headwinds that we might start to see before we go crazy and think real estate only goes up. All right, so let's start with that. Buyer demand. It is absolutely surging. I've been sharing this with you every week because I just love the fact that we're starting to get this week-to-week data. For a data junkie like me, it's always good. And in the markets like this, when we can't really have good understandings of year-over-year data, we can't even really have strong indicators from month-over-month data. We need this weekly information. And again, real quickly, what AIE, the American Enterprise Institute is putting into here is what is the rate lock each week? Where is it going? Again, a rate lock is not a shopper, not a looky-loo, not a pre-qual. That is, I found the house I like, I wrote an offer, I need to lock my rate and lock it in so that I can close at this number. So it's that first, the last early indicator on what sales should do. Unless it falls out of contract, it will become a closed comparable. So that's why I've been liking this report each week. And it continues to go up. We see here in the light blue, I believe that's light blue, record high, well, I don't know if it's a record, but it seems like it. This is compared to last year. So you can see far outpacing where we were last year in terms of rate locks. This is across the country. But again, I start with this view so you can go down to California and then we'll end up in Silicon Valley. So you can see that big picture, get as much of an idea of what's going on everywhere in our market so we have a better understanding of what's happening in ours. So we all remember the hot start we had to this year, and this is where we were, way over last year's number. Here's the sudden fall. Here's the V-shape or swoosh shape recovery, the Memorial Day weekend dip, and boom, the last 2 weeks, super strong. So everything pointing to a great June and enough momentum into, I think, a really good July. Here's what I was talking about earlier. And last week, how quickly things change. Everyone year over year is up, even New York. Thank God, finally, looking out for our peers in those markets, up 42% year over year. Everywhere is up 30, 40, 50%. California showing strong after a really weak March and April, growing every month. And now still mid-market in terms of relative strength to the rest of the country. But when we start talking about prices and units, you'll see how good that number is. And then, of course, in the Bay Area, we're driving a lot of that number here just from our local market. Another thing that we've been monitoring closely on these weekly calls is foot traffic, a very early indicator on what can we expect next in the market. This also is from KCM. And a reminder, people shop before they buy, making foot traffic a great leading indicator of future market activity. And it has been strong. It dropped in March and April. We're going to look at the local numbers or the recent numbers in a second. And I've been sharing that with you every week. And here it is. So another great shout out to Showing Time. Great indicator for you when you're in the market, when you want to understand what's going on in real estate, what's happening next. These are not closings, these are not pendings. It's just measuring how many people are looking at houses, how many people are out there shopping. And again, trends you'll see everywhere when it comes to housing and really any economic indicator during and post SIP. Sudden fall, a gradual but overall quick recovery back to where we were at the start of SIP and back over last year's number and far above previous peak this year. So you can see it now, but those of you that have been watching every week, we've been pointing this out because we've been telling you, pay attention to this as it grows. That's going to have a strong week here, points to a strong closing week coming, and we continue to see that. Again, which will be the theme of tonight, all positive news, but there's the but, and here's the but on this early indicator. We have seemingly reached a peak. It is flattened over the last couple of weeks. That's still a great number. That's still way higher than it was last year, way higher than we were pre-SIP, but nothing goes up forever. Nothing falls forever, although it can feel like it. And so again, if I've been telling you, watch this week over week to tell you what's going to happen next, if that holds true, then this shows a coming flattening at the top of our current selling season and a really great indicator for you, whether you're a buyer or a seller or your realtor, answering the tough questions for those buyers and sellers, what's going to happen next. Here's your first little clue. So existing home sales, again, I mentioned this briefly, 3 acts so far this year. And for this year, I'm counting November, December of last year. When you start breaking down the trends into really smaller segments, about mid-November, our market started taking off. December was a fantastic December. January and February, absolutely on fire. The first week of March, still everything great. And then March 15th happened and boom, second act comes. That was the SIP Act. That was everyone's nervous. Everyone's wondering what's going to happen next in everything generally, not just in real estate. And we just stopped. We didn't do anything. Listings fell, sales fell, closings obviously followed, and that was that second act. And that lasted about 3.5, 4 weeks. That early stay in place or figuring out real estate was non-essential, and then we were reclassified as an essential business. We started to be able to do more of our traditional real estate activities with new mandates, new procedures, and it started to open up a little more and more. We're now into second phase, in some places third phase of opening up in California and the Bay Area. And so now we're into that third act. The question will be, how long will that last? And this is what we're going to talk about. So existing sales, overall numbers down year over year, nationwide, region-wide, statewide, locally, especially in the West, but we are starting to see pent-up demand bring sales back to life as SIP orders are slowly lifted across the state. So if you pay attention to this number, it just looks bad. But again, this already took place. There's nothing you can do about this. Look forward. 2020 was outperforming the previous years until SIP, as you can see here. Again, we won't go into detail here, but you can look at the slides later or the recording if you need that. And also, this is from Keeping Current Matters if you want to access the information yourself. Really great source. All of that has been had a really dramatic effect on prices. And I wrote the note here, prices, seemingly nothing can stop the upward trajectory. And I can legitimately say that with what we've experienced in the last several weeks, and they continue to rise. Case-Shiller, obviously a great indicator, the 20-city composite, great through starting in July of last year, rising consistently. When this comes out, March and April will be down, but I say that because I know June will be right back up in July. So we'll get a dip here once that number is released, but we'll be long past that dip in terms of our current activities. So that's why I point this one out here. Here's what I was talking about earlier. Nationwide, despite all the negative news we hear about living in California, the numbers don't lie. When we look at expected price growth throughout the country, no one has a better outlook than California. 5.7% outlook for the coming year. So this was also, someone asked me earlier today, where did I get this? This was from KCM. I can't recommend them enough. Always have really good, really strong information, and they make it really accessible to you in terms of a visual and understanding what is going on. So 5.7% increase in prices projected for California. So that's why I keep saying, buyers, great time to go out there. You're going to gain the equity once you buy that property now. Why that'll happen? Simply because of inventory. We sound like a broken record for the last 7 years, but a lack of inventory remains a chronic problem. This is going back to 2011. The only thing new is that we keep going lower and lower and lower. Interest rates keep falling and falling and falling, and prices keep rising and rising until inventory and or interest rates change and that buyer demand goes away. You can expect prices to continue to rise. At worst, they will maintain. We're going to need a dramatic change in either inventory or interest rates or the overall economy for that to change. And right now, that's not on the horizon. But again, something we should be well used to, both as professionals and consumers. For a large part, the last 4 or 5 years, consistently and chronically in low inventory markets. And here we go to Silicon Valley. You're going to see based on all those things, national numbers, they are true here. And in terms of projecting prices, demand, interest rates, it just shows continued strength. So the recovery continues to show strength, but we have early indicators that it's a pent-up demand. We'll explain the difference between that and what that means. We interrupted the selling season and are just finishing later. June and into July should be slowing down, not heating up. And I used this analogy earlier. It's just like the NBA. For you sports fans, know the NBA was about 3/4 of the way through its season. And in March, they had to stop all games. They had to put everything on hold. They've not had a game. They haven't had any players in, nothing going on. The standings have been frozen. You're in first or last, and you don't know what's next. Well, now they know what's next. Now they're going to restart the season. They're going to start a tournament in Orlando, I believe. And so what I point out here is it's still going to be the NBA. It's still going to be basketball. It's just going to be a little different. It's going to finish a little later. The format's going to be a little different. But once the games are there, you're going to watch. You're going to be excited. You're going to root on your favorite team or root against the one you hate the most. Remember, fans are fanaticals, and that's where that comes from. And I think real estate's going to be the same way. This is not going to be a normal June. This is not going to be a normal July. It's just finishing a little bit later. And so here we go. Again, from the AccuList, reported every day. Here's what we have seen since SIP, since showings resumed, and what the market has been doing. New listings recovering nicely. That was a lead indicator to our solds. Again, initial dip crossed here and then started to recover nicely and grow. And so here's what you see in terms of prices. Now, in the last couple of weeks, we have seen that new listing surge peak and actually drop. That's a leading indicator. You can't sell what's not on the market. So this is going to, as these converge in the near term, put a really dramatic pressure on upward pressure on prices. So this is going to continue for the foreseeable 2-3 weeks. As we see that, we will look for an increase in new listings and at the same time see if that buyer demand continues at this rapid acceleration. But again, something to watch. Overall, again, you see the overall trend year over year and in our recent weeks versus SIP weeks, new homes listed continued to grow, then it took a slight dip. Sold listings, again, continuing strength. The dip in new listings won't affect solds yet. That is a lagging indicator to the lead indicator that new listings are. So I can tell you for the next week, 2 weeks, easily continue to see this upward pressure on prices, and we'll monitor it week to week to make sure that those balances stay there. Change to pending, same thing, another lead indicator, growing post-SIP order and stronger than it was last year. So here we go. On June 6th, I was sitting at home and I was starting to look at the numbers for the county, recording it to the month-over-month numbers. And I saw this for South County and I said, wow, look at the pending numbers and look how fast they're growing. So I say this because I was motivated to send a post out on Facebook that morning. And I said, if you're interested in buying in South County, Gilroy specifically, go today and buy a house because you're not going to want to compete there in the coming weeks once these pendants become closed and they become comparables to the pricing that's coming. And so I say that because we're going to talk about that with this week's numbers, and it's going to basically be the same message. And that's how fast our markets are moving right now. That was June 6th. That was only 10, 12 days ago, and that's how fast our markets move. So you need weekly information to truly advise your clients, and you need to further break down local news because we have micro markets throughout Silicon Valley. And so that's what we want to focus on next as we jump into the county data. So here we are, starting with Santa Clara County. Again, inventory, SFR is trending down again. So we've had a down, up, down week. I don't know if that's normal because Overall, that's normal for June, but we're going to figure out whether that's normal for a post-SIP environment. What I do know is pendings continue to rise week over week, and that is not always normal for June. That's when we start to see some dips, typically in our normal market. So again, why are week over week and current trends and the recency bias of what's happening right now are so important, because we will trend where year over year numbers are not as reliable. Month over month numbers will not be as reliable. And I can tell you that'll be true for at least the next year, because in 1 year from today, when we look at year over year numbers, if we're up in all categories, it's because we were historically low numbers this year. So really, I hope you understand and rely on how important the week-to-week flows are going to be to give the advice your clients need right now. So in that local number, here we see again year-over-year changes in active and pending for SFRs, condos, and townhomes. You're starting to see them kind of balance out. This is still super low, but they see that pending reaching 2019 numbers. And we're starting to see that imbalance where pendings are recovering much faster than the actives. And that again, is once again, upward pressure on prices. The increases from the start of the year, I always love to record that. And again, you see the same thing. Actives, nice recovery, up 157%. Pendings, incredible recovery, up 120%. And you can see from where we started relative to last year, that growth from the start of the year is better than last year's, but we started at such a low number that our overall inventory is still 500 units lower in SFRs in the county and 200 units lower in condos and townhomes. And so that inventory crunch is really, really elevated right now at the very moment that buyers are saying, let me in. Look how close we are in the pending numbers year over year in both categories. So sound like a broken record, but once again, you can all say with me, that's upward pressure on prices across the board. Here we are for the month over month numbers, and what I focus on here is the current versus previous month. Again, I don't know what COVID numbers are supposed to look like, so I can just compare it to the only COVID period I know, which was May. And so here overall, you see in the county, the for sale numbers recovering nicely from April to May. We just saw it's still really super low, but on the way up. Pendings recovering even better, almost doubling from April to May. And solds is always a lagging indicator. So I told you last week, don't worry about that number. And here's the proof, all right? Comparing the first 2 weeks of June to the first 2 weeks of last May, or just a month past May 2020, for sale, the rate of increase has slowed down. It's only up 3.2% in the same period, while pendings has also slowed down, but still a fantastic number. This is that headwind, and this is the idea that was that really strong surge in May, early June, just the pent up demand of people, that buyers that could not get out there in March and April and early May, or is this a long-term number? I think this pace in the first 2 weeks are showing it was pent-up demand. Still long-term positive, but I don't think we're going to see these massive 70, 80, 90% numbers month over month. And that makes perfect sense, right? But it's still very strong. That's a great number. As long as this pending number is outpacing the for sale number, you're going to have, at worst, a maintaining of values, a protection of the equity gained. But if it remains this imbalance, they should continue to rise. I'm gonna gloss over this because I'm still not really trusting the combined days on market number, because we had that period where they weren't being recorded. So it's just there if you need it, if you want it. I don't think it's that helpful right now. New listings is, and again, here we see April to May, strong recovery, 43% gain. And we continue to see positive, but nowhere at that rate in the first couple of weeks of June, and certainly not keeping pace with the pending. So I'm happy to see the sellers coming back out, testing the waters, seeing that it is a good time. But frankly, as professionals, I think we need to do a better job of going out and talking to as many homeowners as we can, letting them know what's going on in the market. I would hate for them to miss a really hot market in the next 2 to 3 weeks simply because they were listening to national news, watching socioeconomic news, and not focusing on economic data, housing data, and specifically housing data in Silicon Valley right now, which is all fantastic. Pending sales, the absorption rate, the best indicator in these last 90 days of what's going to happen next. I've started to share with you, and I hope you're starting to understand it if you tune in each week. Again, April, May, big jump, 44% to 73%. And again, June is going still stronger. So continue to rise. Frame of reference, anything above 17% is a seller's market. So we're nowhere near the buyer's market. We never got there. Even at the bottom of the SIP order, we were nowhere near a buyer's market. It stayed and remained and bouncing back into an even stronger seller's market. This will continue to go up. The trajectory should be strong to finish at or near 80 for the month. So great thing for you to understand and see. The lagging indicator, the closed sales, you can see that it was trailing. It dropped from April to May, but again, in June, it started to show a really nice recovery. So our closings, oh, sorry, I put the wrong number there. That is the right number, wrong category. Strong for the month, and it will continue into the foreseeable future. This, again, I'm still not trusting because of the reporting and days on market, but overall, still really strong. You're going to get really good offers on the properties that you list. So the heat maps, again, all red. Don't let the red fool you. These are way nicer, much lower red numbers than they were just a few weeks ago. So I did just show you the rate of increase is slowing down, but it is still positive. And we're still seeing increase in inventory across all our markets in Santa Clara County. And then here's the pendings. Look at all the black numbers starting to pop up. So lower overall, but real strength in this 87, 85 corridor, just south of downtown, all the way into Almaden and even Santa Teresa showing strong numbers. Evergreen popping up, increase year over year in pending. So really great indicator about the appetite in the market in these micro markets. And again, even the ones that are in red are growing year over year. So don't be fooled by the red number. Follow the trend week over week. These are all positive. All right, San Mateo County, kind of the same information, or at least the same trend. Smaller numbers, obviously, in Santa Clara County, but overall trending the same way. Inventory, both categories jumped in the week. Pendings are rising week over week after a drop in March, but the balance remains healthy in terms of maintaining equity growth. The year over year numbers, flat, almost flat across the board, except in pendings. Someone asked me in Antero Now this afternoon what the difference was in SFRs and townhomes, and I said, and I promised you, it's really interesting. In San Mateo County, the pending are rising at a much faster rate than the SFRs, and here's that number that I was promising you earlier today. So overall, still not as big a market, it never is, as SFR, but the buyers are reacting at a much faster clip to the condo townhome market in San Mateo relative to the single family residence market. But don't be fooled, this is growing quickly too. But we'll see next week if it's an anomaly, if it's a one-time jump. These are numbers that are low enough that one hot week can really dramatically influence it. So let's watch next week and see if that continues. Overall, same kind of numbers. The for sale, good recovery April to May, pended super strong, and sold was already positive from April to May. And you can see in the June numbers, first 2 weeks, for sale growing nicely, pended still really super strong. This you already see lower than the rate of increase from April to May. So another thing to watch. Still positive, still faster, growing faster than the for sale. Again, positive pressure, upward pressure on prices as long as this continues. The absorption rates, the new listings, again, really strong showing from April to May. And while not as strong, still growing strongly in the first 2 weeks. Expect that to continue for certainly the last 2 weeks, which will mean June will finish strong. You don't have to wait for Case Shiller in August to tell you July. June was awesome. I'm telling you right now, it's going to be awesome. The pendants, still strength, still growing really quickly, not at the same rate as the April to May, but overall really positive and much stronger than new listings. So that's going to be, again, showing up in our closed numbers. Buyer demand, buyer appetite greater than sellers coming onto the market. Positive news for protection of equity. Here's those pendant sales I talked about. The April to May numbers, really positive, nice solid change, way above the seller's market indicators. And again, strong into the first couple of weeks of June, up to 70%. That would be right around here. That would be one of the strongest numbers we've seen in the last 15 months. So it's like almost what SIP. Buyers are charging into the market and really taking everything they can take in the market. So let's get out there. Let's talk to sellers. Let's show them how strong the market is. Put these homes on the market so we can maintain this balance. The close, again, trailing indicator, lagging indicator to the pendings and the absorption rate for pendings, but still super strong. A slight dip, like in Santa Clara County, April to May, but growing ever so slightly in the first weeks of June compared to the first weeks of May. Again, that should be net positive, especially with the pendant numbers to finish a strong month of June in San Mateo County. San Benito, our smallest county, but the hottest one, and not just because of where it's located. Once you see these numbers, you're going to be amazed. So inventory across the board, 7th straight week with a slight dip. That's a problem with demand growing. Pendings are rising week over week after a drop in March at a really fast rate. And here we are. In the single family, which is the entire market for San Benito County, active is only up 16% from the start of the year, down 23% year over year. But look at those pending numbers, 27% higher year over year, and growing at 160% clip from the start of the year. So this is a fantastic story. If you're in that market, if you're a buyer, go in strong. That's all I can tell you because the competition is hot. But that shows a long-term trend. If you go back to 2019, South County is a really good bet right now. It is growing fast. It is really, I think, even last year was a really great option for consumers, and it's continuing that way this year. You see inventory down year over year, but that is going positive every single week, meaning it's still red, but it's getting smaller each week, and the pendings are just blowing up. Really fantastic appetite for South County living right now, San Benito County. And you'll see it here. I teased you with that first number in Gilroy. It's the same is true in San Benito County. You see the for sale numbers, April to May, dropped. It didn't go up like San Mateo and Santa Clara County. They actually dropped, and it didn't deter the buyers. 233% increase from April to May, and it's continuing strong in the first weeks of June. And that 66% is not as strong as that number here, but you see the for sale is going the opposite direction. So net, you have almost an 80% difference between the rate of change in for sale to pended. That's going to finish a strong, really good month for sellers that are trusting the market and going out there in June. And I can guarantee you right now, that momentum is going to be strong enough to keep July really good too. So all good numbers really in San Mateo and San Clara County. Relative to size, the percentages are just astronomical in our South County areas right now. You see new listings again, cannot keep pace with the pendants. And this month, so far, flat compared to May. So expect more of the same. The pended absorption rate almost quadrupled from April to May and still rising in the first weeks of June. This is going to have a really dramatic effect on the closings for June and give us enough momentum to finish July strong. The closing numbers, it did drop into that just borderline buyer's market, probably lasted a week and really ramped right back up into a really positive number in closed sales. And the super strong pending numbers are going to drive this through the roof the rest of June and July. So strong market everywhere, really good indicators throughout our 3 major county areas. If you're a consumer, I hope this really clarifies if your agent is telling you things that you think are crazy, they're not. What we see in our local real estate market is counterintuitive to the narrative you're hearing in terms of news. Globally, nationally, what's going on with COVID-19, what's going on with unemployment, what's going on basically everywhere else. You turn on the news and it's all bad. But if you're listening to someone that's really in tune to the markets, understands these numbers, understands this data, really good time to be a seller. You're going into a strong seller's market, certainly for the rest of June, I think into July. And buyers, the market's helping you with super low interest rates. Even as prices rise, lowering interest rates are going to keep your monthly payments about what they were in previous months. You can continue to expect a low rate environment for the foreseeable future, and inventory continuing to stay super low, rates staying high. As long as the overall economic news remains flat to positive, that's going to show a continued increase on prices for the foreseeable future into 2020, 2021. So great time to buy. So I think I made it right under 7 p.m. I hope I shared some really good nuggets for all of you out there, whether you're a professional, buyer, or seller side. Really, really positive real estate news. Starting to see some headwinds that I think are not going to turn anything negative, but we'll start to potentially see the upward trends slow down a bit. And I will remind you, when you're in a rapidly increasing market, the recency bias can make a slowdown in growth seem like a reversal. So we'll watch next week and we'll see if those headwinds grow. We'll see if that's flattening of the showing numbers. We'll see if the slowing rate of pendings continue and how that will turn out into pricing. But I can guarantee you the next week, the next 2 weeks, the next 3 weeks, finish June hot. It's going to be a really strong market. And because we stay on top of it week to week to week, you're not going to be caught by surprise in June or July or August. So keep tuning in. I don't know if there's any questions, but if there are, if you don't have them now, get to us later and we will answer them for you. So with that, I will sign off. Have a great evening and we will see you all next week.